Hello everyone. Welcome to TrainHR's live webinar on international payroll. My name is Liz and I'm going to be your host today. On behalf of the TrainHR team, I would like to thank you for being part of this event. Today's webinar will be presented by Dana J. Rim. Dana is CPP FPC, is currently the payroll tax manager at PetSmart Incorporation. Dana has been heavily involved in the payroll field over 15 years. Starting as a payroll clerk at a small taxing company, Dana moved on to be a payroll team leader at Honeywell Incorporation. During Dana's time at Honeywell, she obtained her fundamental payroll certification through the American Payroll Association. She also received several merit awards for customer service and acquisitions. Dana is on no strange to teaching. She has taught at the Metro Phoenix American Payroll Association meetings and at the Arizona State Payroll Conference. Dana has her certified payroll profession through the APA. She also serves on the National American Payroll Association on the National Strategic Leadership Task Force and Government Affairs Task Force. We are really honored to have such a distinguished person such as Dana with us to present this webinar. Ladies and gentlemen, before we begin, I would like to inform you of the program outline for today's training session. Today's webinar is for 60-minute duration. First, Dana will take you through today's webinar, highlighting the area that will be covered, and she will then share with you her presentation. I would also like to inform you that all participants, once part of this teleconference, have been placed on mute and will remain so until the Q&A begins towards the end of this webinar. This is for the purpose of avoiding discontinuity and for allowing the presenter to speak clearly so that everyone present can take maximum benefit from this webinar. We also request all to hold back your questions until the Q&A window begins. 10 minutes of time will be allotted for Q&A, during which your questions will be answered. And if for any reason you get logged out of this training session or teleconference, I request you all to follow the same procedure to join in again. Now that we are all ready to start, I request Dana to take it from here. Dana.
Good morning and welcome to International Payroll. We've got a lot to cover in a short period of time, so let's get started. First, let's talk about what we're going to talk about today. We're going to talk about concepts on how to handle tax for your international assignments. We're going to talk about the different types of tax plans, one being a tax equalization, the second one being a tax protection plan, the benefits of each and how you would administer each. We're also going to talk about some best practices for administering a tax equalization program. I spend a lot more time in this webinar on tax equalization than tax protection because we find that most companies use the tax equalization program. Accounting for tax equalization, how do you account for that on your accounting side? A brief overview of visas. We're going to talk about international visas and how to handle them. And then payroll for your inpats and your expats. So what is tax equalization? So there was a recent survey data that indicates 96% of U.S. companies that have international assignments use tax equalization to manage employee tax matters while their employees are on international work assignments. The purpose of tax equalization is to eliminate the tax burden on the employee for the difference in the tax rate between the international assignment of the location of that international assignment and their home tax location. So what that means is, if you send your employees to a country to where their tax rate is higher than the U.S., the tax equalization is meant to eliminate that burden from the employee. So then that way they don't have to handle the burden of taxation either between two countries or such a higher tax rate than what they're used to in the country that they're performing services for you in. So how does tax equalization work? Since now we know what tax equalization is, we're going to talk about how does it work. One is it's an agreement or contract between the employee and the employer. I can't emphasize enough that when you have an international assignment, it is critical for your company to have a very well documented, put together process for your employees that are on international assignment. That process would include a policy that's very clearly written for the employee that understands all aspects of that assignment, which includes the payroll side and the tax equalization and how an employee is going to be handled. Such things as, is your company going to pay for the employee's tax returns at the end of the year? If so, how is that going to be handled? Are you just going to pay for it as a company, or are you going to pay it directly to a particular company that your company has chose, and then that employee would work through them? All of that needs to be documented. As part of that agreement, you need to make sure that it's very clear for the employee that they understand that you're using the tax equalization program and how that is going to affect them and you as the employer. It's critical that it's for a defined period of time. So the IRS only allows us to have a temporary work assignment for our international employees. So you can't send somebody over to another country or bring in people from other countries into the U.S. for, an extended period of time. The IRS has a deadline of 5 years that you can have an international assignment. So when you have these, you're thinking about having these for purposes of special projects. I've seen some companies do it for developing new things, potentially for having that particular skill set for a new system you may be putting into place for your company, anything of that nature. So it is for a very defined period of time. Now, since the IRS does give us 5 years, you can do up to the 5 years, but you can do under the 5 years. The employer pays the employee's actual home and host taxes. So as the employer, you actually step in as their tax advocate, meaning that the employer is funding the taxes for the home and the host country. In exchange for that, the employee is paying what's called a hypothetical tax to the company. So ultimately, the company is paying the required taxes on time based on that country's requirements between the U.S. and the host country. And then in exchange, the employee has a deduction out of their payroll check, which is called hypothetical tax. So then that way the employee throughout the year is paying the company back for those taxes that they have to endure. So the first thing is the company makes you a deal or a contract that goes like this. The company will agree to pay all of your actual home and host country taxes during the 3-year assignment. So let's say it's a 3-year assignment. You agree to pay the company a hypothetical amount of tax that approximates the amount of tax you would have paid had you remained in your home country with the same basic income. So the difficulty with this is, and we're going to talk a little bit more about hypothetical tax, is, again, this is amount of tax that is approximately the amount of tax that the employee would pay if they remained in their home country with the same basic income. So again, as we talk through hypothetical tax, keep in mind, you're always constantly reevaluating your hypothetical tax. And again, sometimes it's very difficult to come up with hypothetical tax because you don't always know your employee's personal situation. The employee pays no more and no less than their hypothetical stay-at-home tax liability. So again, that's the goal of the tax equalization program, is to keep the employee at the normal, pretty much take-home pay that they're used to. So that, yes, they obviously are going to be paying this deduction for hypothetical tax, but typically that would be the same as what they would pay as if they're at home and they're having the taxes actually withheld and they didn't have the hypothetical tax. Again, that's the goal, is for the employee not to feel burdened by the fact that, hey, I'm in a country that has a much higher tax rate than my home country. Hypothetical tax is withheld by the company. Most companies I see withhold hypothetical tax. Even though we call it a tax, it's still a deduction. It's not going to fall in your taxes because, again, it's not a true tax because it's actually being paid to the company, not to the taxing jurisdiction. And then obviously the company pays all actual worldwide tax liabilities. So as you can already see, this is a very costly thing for companies. So again, it's something that a company really needs to consider the value of sending someone either to the United States or out of the United States to do particular work for them, because since the company is paying all the employees' tax liabilities, it can be very costly. So the downside, so here we have this tax equalization program. What's the downside of hypothetical tax? Hypothetical tax is generally computed based on company and non-company income. This is also referred to as your stay-at-home income. So one, you're calculating it based on the basic company income, what you know as the employer. It includes obviously their base salary, bonuses, stock options if there are any. It does not typically include foreign allowances or premiums that may